Hi, so as we discussed in the previous video, when arch effect is present, autoregressive model is not an appropriate model specification. In this case, you might try to use arch or GARCH model. Arch stands for autoregressive conditional heteroscedasticity model. And before we discuss which data properties are consistent with arch, I would like to recall the idea of stationarity very briefly. So as you should remember, stationarity refers to such a property of time series when mean and variance are constant over time. In case of arch, you might use data which are non-stationary in terms of mean, so mean is not the same over time, it changes, and still the variance shall be constant. GARCH is less restrictive. GARCH stands for Generalized Autoregressive Conditional Heteroscedasticity Model, and it might be used both for data which are non-stationary in terms of mean and non-stationary in terms of variance. Of course, there are many potential applications for GARCH model, and one of them is analysis of returns on financial markets. So, returns on financial assets are frequently non-constant, both in terms of mean and in terms of variance. Let us consider this example. So on this graph, you can find two time series. So red line stands for weekly returns on Mostastal. Mostastal is one of the firms listed on Warsaw Stock Exchange, and weekly returns were calculated at the percentage difference between close prices of weekly frequency. And week 20 is index, which consists of top 20 firms listed on Warsaw Stock Exchange. And week 20 returns were calculated in the same way as the percentage change in weekly prices. So, it might be really hard to assess visually, but the first thing to notice is that variance is not constant. So you have areas with smaller dispersion and bigger dispersion, which basically means that variance is not constant over time. The additional thing is that mean does not seem as constant as well. Of course, it would be more visible if we analyze a longer period, but unfortunately it was not possible because of data availability constraint, but still there is a kind of upward trend. Okay, this is questionable, but even the fact that variance is not constant is enough to use the GARCH model. And we will apply GARCH model in order to estimate capital asset pricing model. So capital asset pricing model is a very popular tool in financial analysis, and according to this model, return on asset can be analyzed as linear combination of alpha, constant term, and the product of market beta and market premium. So this term, aggregate return from market and minus risk-free rate, stands for market premium. It's like reward for risk. So you subtract what you can get just if you invest in completely riskless asset and what the market can offer. So typically risk-free rate is assessed as government bond yields, like return on investing in government bonds, because they assumed to be the less risky asset in the economy, but we are not going to use this variable because we are estimating this model just for demonstration purposes. And when it comes to market, it's typically aggregate market return, like week index or S&P 500 index or something like this. So we will estimate GARCH model. As usual, you can find the dataset in materials for this lecture. Model GARCH. Okay, so we will get back to this a bit later, but those two indicators specify the order of GARCH and ARCH. So let's assume 1 in this case, and let's assume there are no legs in this model, because this is what mathematical model tells you, yeah, like piece of financial theory based on which we estimate this model. Okay, so yeah, this is the output. Okay, so when it comes to specification of this model, there is no good way to decide on the order of GARCH and ARCH except for information criteria. So information criteria basically stands for estimator of prediction error. So basically, smaller value of information criterion is better. It means that your model is more reliable. It does not tell you anything when it comes to the absolute quality of the model. Let's put it in these terms. I mean, on whether your model is good enough or not good enough. It can be used for comparison of two models solely. So we might try to specify different order, and in this case our model will have lower value of information criteria. I mean, for both of them. So yeah, basically you can just, have fun with the model, try different specifications, and choose the one with the best information criterion value. And the best means the smallest. Okay, so that was it when it comes to ARCH and GARCH model. In the next video, we are going to discuss ARIMA model. So I really hope you enjoyed this one. See you.